Okay, so you want to own a theme park. Not a chain, just one park. One gate, one castle, one set of turnstiles clicking through a summer crowd. Here's the first number, before you sign anything. The newest major theme park in America, Universal's Epic Universe in Orlando, costs somewhere between $6 and $7.7 billion to build. 750 acres. Roughly 5 years from the first shovel in the ground to opening day. For comparison, Shanghai Disneyland, the last brand new full Disney park to open anywhere in the world, cost roughly $5.5 billion. Each installation of Star Wars, Galaxy's Edge, a single themed land inside an existing park, cost over $600 million on its own. Not because Universal wanted a big park. Because a small park doesn't compete. Not against Disney. Not against Universal's own existing resorts 3 miles down the road. Against the guests' expectations of what a real theme park is now supposed to look like. And here's the part that should really bother you. On opening day, admission tickets, the thing everyone assumes is the business, will cover barely more than half the bill. Across the U.S. amusement park market, tickets hold roughly 44% of total revenue. The other 56% comes from somewhere else. Food, merchandise, parking, hotel rooms on site. A skip-the-line pass that lets you jump the queue you already paid to stand in. You didn't buy a ride ticket. You bought entry into a 4-hour retail environment with a roller coaster running through the middle of it. Nobody tells you that part going in. And it isn't a new trick. Disney's own California Adventure went through an early 2010s reimagining that cost well over $1 billion. Not to build a new park from nothing, but to fix one that had opened underwhelming and needed a second, even more expensive round of investment just to compete with the resort standing next door to it. Universal Beijing, opened a few years earlier, cost roughly $6.5 billion on its own. This is what the industry now considers a normal price of admission just to be allowed onto the field. Here's the illusion. You picture a theme park as a standalone business. Build the rides, sell the tickets, count the money at the end of the day. That's how it looks from outside the fence. Here's the reality. In fiscal 2025, Walt Disney's Experiences segment, parks, cruises, resorts, consumer products, generated $36.2 billion in revenue, up 6% on the year, with segment operating income hitting an all-time high of roughly $10 billion. In the quarter ending in late December 2025, Experiences accounted for 38% of Disney's total company revenue. It accounted for 71% of the company's total operating income. Just over a third of the revenue is producing almost 3/4 of the profit. That's the scale. Here's why it isn't a simple business. A theme park is not one business. It's 4 or 5 businesses sharing a single wristband. It's a real estate operation, sitting on land whose long-term value can outrun the attraction built on top of it. It's a retail operation, because food and merchandise carry margins the ride itself will never touch. It's a hospitality company, running on-site hotels that pull a second, higher-margin round of spending out of a guest who already paid to get in. And it's a subscription business, because annual and season pass holders, not single-day tourists, are the base the entire revenue model is quietly built on. Industry-wide, ticket admission still accounts for something like 55 to 65% of a typical park's total income. And among the 2 biggest publicly traded operators, the numbers run close to that band. Disney's own fiscal disclosures put admissions near 58% of segment revenue, while the newly combined Cedar Fair filings place it closer to 61%. That's the number a park's finance team defends every year. It's not the number that actually determines whether the year was good. Six Flags learned the real lesson slower than Disney did, and it cost them. In 2001, the average Six Flags guest spent $30.99 per visit. By 2005, 4 years later, that number had crept up to just $33.35. For years. For percent growth, in a business that survives on pricing power. New ownership took control that year and pushed per guest spending up 14% over the following 2 years, by raising ticket prices and food prices at the same time, and by shifting capital spending away from headline thrill rides and toward lower-height family attractions designed to pull in more paying children per household. But push per capita spending too hard on the wrong guest, and the math turns against you. A pass holder who visits 12 times a year pays a fraction of a single-day ticket price for each of those visits. Every extra trip they take drags the average revenue per guest number down, even while it fills the park with bodies on a Tuesday afternoon in September. Chase the loyal repeat visitor, and your per capita spending looks weak on the quarterly report. Chase the one-time high-spending tourist instead, and you're betting the entire business on people who might never come back next year, in a market where 3 or 4 competitors are chasing that same tourist with the same dollar. That tension sits underneath almost every pricing decision the industry makes. Keep it in mind. We're going to watch one company get caught on the wrong side of it more than once. There's a second layer to the illusion worth naming here, too. Most guests assume the park they're walking into is owned by the name on the entrance sign. Increasingly, that's not the full picture. Regional and mid-market parks routinely change hands between private equity groups, real estate investment trusts, and operating companies that lease the land back to whoever is actually running the rides that season. A structure that looks nothing like Disney's model, where the land, the IP, and the operation all sit inside the same corporate shell. 2 parks can look identical from the parking lot and be financed in almost opposite ways underneath. Say you actually try to build one. Here's the order the bills arrive in, and it is not the order you'd guess walking in. First layer, land. A large-scale theme park needs hundreds of acres in one contiguous block, close enough to a population center or a major airport to be reachable, but cheap enough that the land cost doesn't consume the whole budget before a single ride gets ordered. Epic Universe sits on 750 acres of land in Central Florida, a region that, across all its parks combined, drew over 75 million visitors and generated close to $60 billion in direct visitor spending in 2024 alone. That scale of tourism is exactly why land near it commands a premium most other parts of the country don't. Every acre has to be assembled, often bought from multiple separate owners, often years before construction even starts, and every year of delay is a year of carrying cost on land earning nothing yet. Second layer, infrastructure before a single themed facade goes up. Roads wide enough for tour buses and rideshare traffic. Water and sewage capacity sized for tens of thousands of daily guests. Electrical service on the scale of a small town. Drainage systems built to handle both a Florida afternoon thunderstorm and a parking lot the size of 100 football fields. None of this shows up in a single photograph of the finished park. All of it has to exist before the fun part starts, and none of it is optional. Third layer, permits and safety certification, which do not move at the speed of a construction schedule. Every ride, before it can carry a single paying guest, has to clear structural engineering review, then state or local safety inspection, and, for anything with a themed storyline built around it, often a separate design and fire safety review for the building wrapped around the mechanism. This step doesn't just cost money. It costs time, and in this industry, time is the one input you cannot get back once a summer season is missed. A single ride delayed past its planned opening date doesn't just lose the marketing push built around it. It loses an entire peak season of revenue against fixed debt payments that started accruing the day construction financing closed, months or years before the ride itself ever turns a wheel. Fourth layer, and the biggest single line item on most budgets, the ride systems themselves. A basic wooden or steel coaster, the kind you'd find at a mid-sized regional park, runs somewhere between $1 and $10 million. The Lightning Racer at Hershey Park, a wooden dueling coaster, came in around $12.5 million. A serious steel coaster, the kind built to be a park's headline attraction, runs closer to $30 million. The Fury 325 at Carowinds cost roughly that. A fully custom dark ride with an animatronic storyline can run $20 to $30 million for the ride system alone, before a single wall around it is themed. And at the very top end, Disney's Expedition Everest, by some counts the most expensive roller coaster ever built, came in near $100 million for a ride that, stripped of its mountain, is mechanically a mid-sized coaster running forwards and backwards through a cave. Fifth layer, theming, which is often quietly larger than the ride budget itself. Disney and a corporate sponsor spent close to $200 million developing Mission Space at Epcot, a ride system that, underneath all that theming, is relatively modest by comparison. The story you're immersed in, not the machine physically moving you through it, is where a large share of that budget actually goes. This is the layer most first-time investors underestimate the hardest, because it is the layer that photographs the best and explains the least about where the money went. Sixth layer, and this one never stops once the ribbon is cut: insurance, maintenance, and seasonal labor. Even a single well-built coaster costs somewhere between $100,000 and $500,000 a year just to keep running safely. Annual inspection, worn part replacement, periodic refurbishment of track and restraints. Multiply that across 40 or 50 attractions in a full-scale park, and maintenance alone becomes one of the largest recurring costs an operator carries every single year. Invisible in every marketing photo, non-negotiable in every operating budget, due whether attendance is strong or weak that season. And the scale of that stack depends entirely on which tier you're building in. A small children's amusement park, the kind with a carousel and a handful of kiddie rides on a couple of acres, might get built for somewhere between $100,000 and $200,000. A mid-sized family entertainment center, bumper cars, a bigger Ferris wheel, a handful of real thrill rides, lands somewhere around $500,000 to $700,000. Jump to a genuine large-scale theme park, with signature coasters, water attractions, and multiple theme zones, and the number moves to somewhere between $10 million and $50 million at the low end of large, before it even approaches the billion-dollar territory Epic Universe and Shanghai Disneyland occupy. Three completely different businesses, all technically called a theme park, separated by 2 or 3 orders of magnitude in required capital. Stack all 6 layers and you understand why a genuinely new, large-scale theme park now costs billions of dollars before it sells a single admission ticket. And you understand something else: why almost nobody builds one from scratch anymore. Epic Universe was the first entirely new major theme park to open in Central Florida in 26 years. The barrier to entry was never the idea. It's surviving 5 to 7 years of pure capital outflow before the turnstiles start paying any of it back. So the park is open. Here's how the money actually moves once guests start walking through the gate. Admission still does the heaviest lifting in raw terms. Industry-wide, ticket revenue accounts for somewhere around 44 to 61% of total park revenue, depending on the operator and how aggressively they've shifted pricing toward add-ons. But admission revenue is spoken for the moment it's collected. It goes straight toward debt service on the construction cost we just walked through, toward the next capital project already being planned 2 or 3 years out, and toward keeping the gate price just competitive enough that guests don't simply choose a competitor 30 minutes down the highway instead. The actual profit engine sits one layer deeper, in what the industry calls in-park per capita spending, everything a guest spends after already walking through the turnstile. Industry-wide, that figure runs somewhere between $30 and $62 per guest, depending on park size and market positioning, and it splits roughly 60% to food and beverage, 40% to merchandise, games, and add-on experiences like line skip passes and souvenir photo packages. The average standalone admission ticket, for reference, runs just under $24 across the industry, meaning for a huge share of operators, what a guest spends once inside now rivals or exceeds what they paid to get in. Food and beverage is the quiet giant here, for a simple structural reason. A guest who is not allowed to leave the park and come back without paying admission again is a guest with no real alternative but the vendor 15 feet from the ride exit. That's not a coincidence of layout. Highest margin items, branded snacks, novelty drinks, are deliberately placed at the highest traffic choke points, because a guest standing in a 90-minute line, having already paid somewhere between $50 and $150 just to be there, does not walk away from a $7 drink out of principle. Universal has sold roughly 20 million units of butterbeer, the signature drink from the wizarding world of Harry Potter, at just under $7 each, since it launched in 2010. At the best-performing parks, that in-park spending, food, merchandise, upgrades combined, actually equals 50 to 100% of the original ticket price. Meaning, for every dollar a guest hands over at the gate, a well-run park is engineered to extract another 50 cents to a full dollar once they're inside the fence. That ratio, not the sticker price on the ticket, is the real number executives are managing toward every single season. And it's why Disney has openly attributed recent revenue growth to rising per capita spending even in quarters where attendance itself was flat or declining. Now, Who's actually eating in the middle of that chain before any of it reaches the operator's bottom line? Start with the ride manufacturers, who are paid up front for construction, take no ongoing revenue share once installed, and carry none of the multi-decade operating risk after the check clears. Add the intellectual property licensors. When Universal built Super Nintendo World and the Wizarding World of Harry Potter into Epic Universe, Nintendo and Warner Brothers did not hand over that IP for free. They license it, typically for an ongoing percentage of related revenue, meaning every butterbeer sold and every Mario-themed plush toy carries a royalty embedded in its price before Universal sees a cent of profit from that transaction. Add payment processing on every one of those transactions, a small percentage skimmed off every card swipe, every mobile order, every add-on purchase made from a phone while standing in line. Add insurance carriers pricing in the liability of 40-foot drop towers and crowds running into the tens of thousands on a single day, premiums that rise every time a competing park anywhere in the country has a serious incident, regardless of whether the ride involved shares anything but a manufacturer with the one down the highway. And ad labor, Six Flags alone, across its now combined operation, carries roughly 4,200 full-time staff and around 91,000 seasonal and part-time workers during peak season, every one of them paid on a schedule that has nothing to do with whether it rained that Saturday. Every one of those parties gets paid whether the season is good or bad. The operator is the only party in the entire chain whose income is entirely dependent on whether enough people show up, in decent weather, willing to spend at the rate the model assumes. Ticket revenue pays the fixed costs. Per capita spending pays the profit. And the operator is the last one standing between a great summer and a very bad balance sheet. Dynamic pricing is the newest layer of that engine, and it's built specifically to defend the per capita number against a soft attendance year. In one recent quarter, Disney's domestic parks saw attendance come in below expectations, largely because fewer annual pass holders showed up. Pass holders whose blocked-out dates are specifically designed to protect guest satisfaction for full-price visitors. Attendance was down. Per capita spending was up 10% in the same quarter, driven by higher admission pricing layered on top of higher food, beverage, and merchandise pricing at the same time. Fewer people walked through the gate. The company made more money anyway. That is the entire strategy compressed into a single quarter. Here's what happens when that balance gets it wrong, twice, at the same company. Six Flags Entertainment traces back to 1961, and by the early 2000s it was one of the most recognizable amusement operators in America, with parks scattered across the US and, for a stretch, Europe as well. Then came the debt. Aggressive acquisitions through the 90s and early 2000s, including a costly international expansion the company later had to unwind and sell off, left Six Flags carrying a debt load its cash flow couldn't service once the 2007 to 2008 financial crisis hit consumer attendance and discretionary spending at exactly the same time. On June 13, 2009, Six Flags filed for Chapter 11 bankruptcy protection, unable to refinance what it owed. It emerged 11 months later, on May 3, 2010, restructured, its old stock delisted, reissued under new shares. For over a decade after that, the company ran quieter and comparatively disciplined. Then, in 2024, Six Flags did something that looked, from the outside, like exactly the right move. It merged with Cedar Fair, owner of Cedar Point, Knott's Berry Farm, and Worlds of Fun, in a deal reported at roughly $8 billion, closing on July 1, 2024, and folding 13 Six Flags parks together with Cedar Fair's own portfolio of roughly 27 properties into a single combined operator trading under the ticker FUN. 41 parks and 9 resorts under one roof, run out of a single corporate structure. On paper, this was the white knight move, scale, cost synergies, and what one industry analyst called Cedar Fair's more disciplined management, taking the wheel of the newly merged business. It did not work the way the deal was sold. By the end of 2025, the combined company was carrying between $5.2 and $5.3 billion in debt. In its second quarter of 2025, Six Flags reported a net loss of $100 million. Its CEO announced he would step down that same August, on the same day the loss was reported. The company issued $1 billion in new, high-interest bonds just to refinance debt it already owed at more favorable terms than the market would otherwise give it. And in its year-end accounting, Six Flags wrote down roughly $1.5 billion in total asset value across its combined portfolio, with a single park, Six Flags Magic Mountain in Southern California, absorbing $533.7 million of that write-down on its own. The stated reasons: weaker than expected attendance, lower revenue, disappointing cash flow. The same park that had nearly been sold off during the company's first debt crisis back in the mid-2000s was, once again, 2 decades later, the one carrying the worst mark on the entire balance sheet. And this wasn't the company's only close call in the years between the two crises. Even during its comparatively quiet decade, Six Flags kept a running list of underperforming regional parks it eventually closed or sold outright rather than continue funding. A slow, less dramatic version of the same lesson. A fixed-cost business that stops generating enough per capita spending to justify its footprint doesn't fail all at once. It fails park by park, market by market, years before the headline bankruptcy filing makes the news. 15 years after its first bankruptcy filing, industry analysts were openly discussing, in print, whether Six Flags might be heading toward a second one. Not because the park stopped drawing crowds. Not because the ride stopped working. Because the company built its recovery on the same tool that caused its original collapse in the first place: leverage, and used it to buy scale instead of paying down the structural weakness sitting at the center of the model the whole time. A fixed-cost, weather-sensitive, capital-hungry business, financed with billions in debt, that does not care whether the summer turns out rainy. So if the operator is the one absorbing every bit of that risk, who's actually winning in this business? One side of this industry is Disney, a company that, unlike almost every other park operator on Earth, owns nearly all of its own intellectual property outright. Mickey Mouse, Star Wars, Marvel, Pixar. No licensing fee flows out the door for using its own characters in its own parks, because Disney is both the IP holder and the operator inside the same building. That single structural fact is a large part of why a segment generating 38% of the company's total revenue can generate 71% of its total operating profit. The house and the content living inside it are owned by the same entity, so nobody outside the company is skimming a royalty off the top before Disney sees its own margin. The other side is Universal, which does not have that same luxury on its newest and most expensive park. Epic Universe leans heavily on Nintendo's Super Nintendo World and Warner Bros.' Wizarding World of Harry Potter, IP that Universal had to license, on ongoing commercial terms, from companies that took on none of the $6 to $7 billion construction risk sitting on Universal's own balance sheet. Nintendo and Warner Bros. Collect a cut of the revenue their characters generate inside someone else's 750-acre, multi-billion-dollar capital project, without financing a single roller coaster, without carrying a single dollar of the construction debt, and without any exposure if attendance disappoints next summer. And then there's Six Flags, a company that owns its real estate outright, owns its ride systems outright, and financed nearly all of that ownership with borrowed money. Which means every dollar of revenue softness runs straight through the operating statement to a lender who does not care about attendance figures, weather patterns, or guest satisfaction scores. The lender only cares about the payment schedule, and the payment schedule does not move just because a summer was rainy in Ohio and cool in California at the same time. Not the guest, paying at the gate. Not the operator, running the rides and carrying the risk. The party that wins with the least exposure in this industry is whoever owns something, land, or characters, or a debt instrument, that gets paid before that season's actual performance is even known. Zoom out far enough, and the entire industry sorts itself along that one line. Companies that own their own intellectual property and can layer new parks on top of it without paying anyone else a royalty compound their advantage year after year. The content library becomes cheaper to reuse every time it's deployed into a new park, a new land, a new attraction. Companies that have to license someone else's characters, or that finance their real estate with debt instead of retained earnings, are running the same business model with a permanent structural tax attached to it. Same rides, same guests, same weather risk. Very different exposure the moment growth slows down. Go back to that opening day, the one you were picturing at the very start of this. The gate. The castle, The turnstiles clicking through. You already know, now, that ticket was never really what you were buying. You were buying entry into a 4-hour retail environment, engineered around a small number of machines built to move you slowly toward the next thing designed to separate you from another dollar. A drink, a plush toy, a photo package you didn't know you wanted until you saw yourself mid-drop on a screen at the exit. Somewhere underneath that whole experience sits a balance sheet carrying billions in construction debt, a royalty check running out the door to a company that never built anything on-site, and a maintenance schedule on decades-old steel that has to hold no matter how thin the operator's margins get by the end of this particular season. So here are the 2 questions worth sitting with on your way out through the gift shop. When you hand over that ticket price, are you paying for the roller coaster, or are you quietly financing someone else's balance sheet, one souvenir cup at a time? And when the next downturn comes, because it always does, is the park you loved as a kid the kind that owns what it's standing on, or the kind that's simply renting the ride until the debt says otherwise?